Hi everyone, welcome again to RHB Assets Management Podcast Series. I'm Fauzi, Chief Investment Officer, Equity Malaysia. Global equities rallied strongly from March low due to the expectations of quick recovery in the economy as countries started to reopen their economies. The equity market performed much better than the real economy due to massive liquidity injections by central banks, especially Federal Reserve of US, which has pushed the government bond yield to its very low level in the history. This has resulted in the rally of other asset classes, including gold and equities, as investors need to find alternative asset classes to get better return. We argued in our previous podcast that the rally in the equity market was too sharp and swift and has gone beyond fundamental value. We were cautious on the speed of the recovery in the economy due to social distancing and companies operating below their full capacity. In addition, the possibility of a second wave to happen was high as vaccines has not been found yet. Hence, the equity market needs a breather and form a base before it can go higher on the expectation of gradual recovery in the economy. We saw the equity market started to weaken in early June due to the increase in COVID-19 cases as a result of the reopening of the economies in US and Europe. The Republic of China also saw the number of COVID-19 cases rising after more than 2 months of reopening its economy. It seems that the pandemic is a long way from being contained. Hence, the economy may not recover as fast as previously expected, as some countries would scale back the reopening of their economies. This will have some implications on corporate profitability and performance of the equity markets going forward. We would expect the index to consolidate within certain band as happened during global financial crisis in 2008 and 2009. However, we are not sure how long the current consolidation will last, but it took around 6 months during 2008 and 2009. The IMF has come up with their latest analysis on the global economy and is now predicting lower contraction in global GDP of minus 4.9% compared with minus 3%, which they have predicted in April. They are forecasting lower contraction even after the strong rally in the global equity market from March low due to stringent lockdowns, which has resulted in even larger disruptions to economic activities. In addition, contrary to the sharp rise in the equity index, IMF is also predicting that the economy might not recover as sharp as expected and recovery would be slow in 2021. Generally, Asia has been successful in controlling the COVID-19 pandemic and has reopened its economy gradually. The IMF is forecasting lower GDP contraction for Asia in 2020 and will grow faster than advanced economies in 2021. In addition, ASEAN countries are expected to contract much lower than other countries in the world. The IMF is forecasting Malaysia GDP to contract by 3.8% in 2020 and recover by 6.3% in 2021. IMF has earlier forecasted GDP contraction of minus 1.7% in 2020 and the economy to recover by 9% in 2021 in April for Malaysia. Malaysia industrial activities plunged sharply in April. The manufacturing sector was the worst hit as factories' operations were halted or restricted from operating at full capacity. The weak global energy market has caused the mining sector to suffer from both depressed demand as well as restricted production. However, the industrial production is expected to have troughed in April before stabilizing in May and June as the economy gradually reopens. In addition, Malaysia exports in April also suffered the worst decline in over 10 years due to the strict virus containment measures implemented at home and abroad. Hence, we expect Bank Negara Malaysia to maintain the accommodative monetary policies for a longer period due to the weak manufacturing and exports performance, and inflation is likely to remain low. Hence, to conclude, in the absence of positive news, the equity market is likely to be volatile in the short term and will be driven by macroeconomic data and geopolitical tensions. Although both the drop in manufacturing and exports will have an implication on Malaysia's overall economy, which is expected to experience recession in 2020, we are of the opinion that the worst of the economy and equity market are behind us already. The equity market is expected to be in favor due to the expectations of prolonged low inflation and low interest rate environment. The gradual recovery in the economy will also support the equity market going forward as investors are pricing in lower risk. The index is expecting to form a base before we see a sustainable rebound in the equity market later. In addition, we are also expecting a shallow consolidation for the index due to ample liquidity in the economy. Thank you.